Hi everybody, it's Peter Schiff. This is Friday the 13th of May 2011. Well, the correction that began the prior week in commodities, in precious metals, continued this week. Also, stocks around the world sold off, not just here in the U.S. And apart from the technical aspect of this, certainly there's a lot of technical components to the correction. And you have a lot of rhetoric out there, politicians really bashing on speculators, and you actually have some of the exchanges ratcheting up the margin requirements, making it more difficult for people to maintain these positions. So there are a lot of other things at work, but I do believe that there is a fundamental reassessment going on in the minds of a lot of people who control a lot of money. What I think is happening is that many people are starting to take a look at the prospects for the U.S. economy. And I think based on the evidence, both in the economy in general and in the housing market in particular, I think a lot of people are coming to the correct conclusion that the U.S. recovery is fading and U.S. economic growth will not be as robust as people had forecast. And as a result of that ratcheting down of U.S. growth, I think people are then making the extrapolation that the global economy will not be as strong as had been thought, especially with global central banks raising interest rates. That might be reining in some of the growth. Also, I think you have a lot of people coming to the conclusion that quantitative easing is going to come to an end in the summer, like the Fed claims. And of course, quantitative easing is a big factor, whether Ben Bernanke wants to admit it or not, in providing the impetus for the rise in commodity prices and weakness in the dollar. After all, quantitative easing, basically by definition, is debasement of the U.S. dollar. It means printing more money, driving down the value of the dollar, which obviously drives up the dollar price of commodities, and which causes other central banks, particularly those that are trying to maintain pegged relationships with the dollar, to print even more money there. So you get global monetary debasement, which all is positive for precious metals and commodities in general. So if quantitative easing is going to come to an end, it's like you're taking away one of the props behind the market. And of course, if quantitative easing is helping the U.S. economy, if you take it away, then it's obviously going to be negative for the U.S. economy. I think a lot of people believe that quantitative easing is certainly a crutch that has helped the economy limp along. But I think they believe that if you remove that crutch, that we're still going to be able to make forward progress, maybe at a slower pace. See, I don't think people understand that it's not really a crutch. It's more the equivalent of life support. The economy is on life support artificially based on quantitative easing. And if it comes to an end, it's the equivalent of the Federal Reserve pulling the plug. The economy can't survive without the quantitative easing because it's phony. But we don't have real economic growth. And that is where I'm parting from this conventional wisdom. I said I agree that there is going to be a slowdown, but it's precisely because I believe the U.S. economy is going to slow down. In fact, not just slow down, but collapse. That's why I'm so bullish on commodities. I am not buying commodities or precious metals because I think U.S. economic growth and global growth are going to mean that commodity prices are going to rise. I think it's the opposite. I think because the U.S. economy is so fundamentally weak that QE2 is not going to come to an end, that it's going to continue, and it's precisely because it's going to continue that we want to keep buying precious metals and commodities because that means more money printing. And for a lot of people who think that, well, if the U.S. economy slows down, then the whole economy is going to slow down as well. The world economy does not need American consumption to continue to produce. Products are going to get produced whether we consume them or not. And in fact, if the U.S. dollar is falling, like I believe it will, all that's going to change is who consumes what gets produced. As the dollar loses value and Americans become poorer, Americans naturally consume less. But as the dollar loses value, it's losing value relative to other currencies. And so people who earn those other currencies, who have those currencies in savings, now they're richer. And because they're richer, they simply buy the products that Americans are no longer able to afford. The global economy continues, except we don't benefit from it to the extent that we have been. Other people who have been living beneath their means suddenly benefit. But if the assessment is correct that the U.S. economy is slowing down, it is not bearish for commodities. It is not bearish for precious metals. It is, in fact, bullish. But I think people are coming to the correct conclusion that the economy is weakening. It's not going to be as weak as they think, but they are selling commodities as a result. They are also, I believe, selling stocks in emerging markets around the world because they believe that if the economy slows down, these types of assets will get hurt more. I think that's probably why the U.S. dollar is rising, because if you have a lot of U.S. funds that are liquidating overseas positions, they are also liquidating those currencies and buying U.S. dollars when they bring the money home. And I think it's also part of this whole perceived risk on, risk off. I think the definition of what's risky and what's not risky are wrong, but you have this correlation between stocks, commodities, precious metals, and the dollar, where when the dollar rises, everything else falls, and when the dollar falls, everything else rises. So everybody is selling what they perceive to be more risky or more volatile, and they are buying dollars where they perceive more safety. That perception is false. Nonetheless, that's what traders are doing. But I think that this correction in the dollar, this correction in commodities, again, will be short-lived. And what I think the smart money is understanding what the implications are for the U.S. economy, just how bad it is, and that the Fed cannot take away the punch bowl. The Fed cannot stop QE2. The last thing it wants is the market to sober up and realize just how bad the U.S. economy is and just how addicted it is to that quantitative easing. The Fed might pretend that they're going to stop it, but there's no way I think that they will, especially given the fact that there is an election coming up. Of course, there always is, but it's a presidential election, and they are not going to be perceived as destroying the U.S. economy in the face of that pressure. Also this week, we got a lot of economic data on inflation. We got import prices that came out earlier in the week. That was the hottest number of all. The import prices were up 2.2% for the month. So you annualize that, that's 2.6%, or 26% rather, annualized increase in import prices. Wholesale prices came out later in the week. We got an 0.8% rise in April. That annualizes out to about a 10% increase in wholesale prices. The consumer price index came out today. I think that is the least accurate of all. Yet it still showed a 0.4% increase on the month, which annualizes out to about 5%. Now remember, Richard Nixon imposed wage and price controls when inflation got to 4%. Even the way the government measures it, it's higher than that now, and they're telling us inflation isn't a problem. Yet it was such a fear back in the Nixon administration that they imposed wage and price controls. Not that wage and price controls are a good thing. They're not. They don't work. But it shows you how concerned they were that they did something so drastic. Even if it was stupid, they still did it. But now we're not even concerned. And of course, back then, the CPI was far more honest because we hadn't had the Boskin Commission. And remember, the reason that the government fixed, in quotes, the CPI is the government claimed it was understating inflation, which meant that the inflation, when Nixon imposed wage and price controls, according to economists, wasn't even as bad as Nixon thought. It was lower than 4%. But when they fixed it, what they did is they deliberately recreated a CPI that would show a lower inflation. That was the goal of the Boskin Commission. So by using geometric weighting and by using hedonics and all sorts of gimmicks and substitution effects, we're no longer measuring a fixed basket of goods every month and seeing how the prices change. The basket of goods changes all the time, as does the weighting of the components. So it's completely worthless for anything other than propaganda. And what's amazing, too, is that the media, how they eat this stuff up, how they look at these CPI numbers as if, Moses just brought them down from Mount Sinai, carved in tablets. The government comes up with this stuff, and they come up with it for a reason, and they deliberately distort it. But even if you buy the government's CPI numbers, it's higher than, it's 5% annualized. This is a lot of inflation, and it's only going to get worse. And I think that's why people like Steve Forbes, I read in an article this week, Steve Forbes was saying that he thinks within 5 years, we will return to a gold standard. And I read an article that was critical of Steve Forbes' assertion because they were claiming, well, how's that going to happen? There's no political consensus for this at all right now. No one in Congress is advocating a gold standard, even the Republicans. They mentioned that Ron Paul, who, by the way, officially announced his candidacy for the U.S. presidency today, and I wish him all the best. They mentioned that Ron Paul was the only candidate that was even talking about this, and of course he's got no chance of winning. That's what they said. Well, what Steve Forbes is looking at is not the political consensus today, but he's thinking about what's going to happen when the currency crisis hits, which is coming, certainly I believe, within the next 5 years. Steve Forbes obviously believes it too. And when that happens, when the dollar is in free fall, when consumer prices are spiraling out of control, when this economy is basically dying of cardiac arrest, of a lethal dose of government stimulus, when unemployment is rampant, right? When they're rioting in the streets in protest, that's when they're going to go to a gold standard. They're going to realize what's happened. You know, nobody quits a drug, nobody admits they're an alcoholic until they hit rock bottom. And unfortunately, that's what's going to happen. Before we admit that we're addicted to cheap money, to paper money, we're going to have to see this economy hit rock bottom. Only then will the politicians be willing to acknowledge the problem and look for a real cure. And the only real cure is going to be to abandon this ridiculous system that really began with Richard Nixon in 1971 when we went off the gold standard, and that was really the beginning of these problems. We're going to have to recognize this, and we're going to have to go cold turkey. We're going to have to check into rehab, and that is going to be a gold standard. There may not be a consensus for it now, but believe me, when things get really bad, we're going to be looking for a solution, and that is the only one that will work. We need discipline, and we need to restore integrity and value to our monetary system, and by reintroducing a gold standard, in my opinion, that's going to be the only way to do it, especially since things are going to be so bad. Anyway, that's it for today. Enjoy your weekend, everybody. I'll be back again, hopefully, with some more insight next week. Take care.